welcome to Safe Space Finance. Today we have our esteemed guest, Monty.
Let's go.
Let's go. Okay, Monty. So the way we kick off the show is we just allow the guest to just give a little intro about themselves and who they are so that everyone knows who's talking.
Yeah. Well, my name is Monty Valapaparam. I currently live in Nashville, Tennessee. I am from Charlotte, North Carolina, and I know Mike from my days in consulting. I had done that in the beginning of my career, and currently I work for a healthcare company in business development and growth strategy on the M&A side. So, um, I guess just a little bit about how I was raised, and if that would influence
Yeah,
maybe
yeah.
this conversation more focused on personal finance. Um, my parents are immigrant parents. They're from India, and saving and wealth building has been heavily important in our family since I was been a kid. And ironically, my dad also works at a bank on the IT side, but he also, works at a bank.
Yeah.
And he's always been, he had ended up settling in Charlotte, North Carolina, which is a very
Mhm.
financial services city,
Yeah.
mainly for like support services, IT, all that stuff is in the banking industry is in Charlotte. And yeah, I've just been around it my entire life, around my dad being a very, very savvy saver and investor,
Yeah.
over the years. He actually now, really proud of him. He has been able to um, make enough money through investments to buy a franchise, and he still works at Wells Fargo full time. And
Mm-hmm.
he
Mm-hmm.
bought um, a commercial printing franchise called Minutemen.
Oh, wow.
It's yeah, they're all over the country. Very good margins, actually, like 30% margins. The
Wow.
only problem is it's a lot of work.
Oh, really?
Yeah, it's a lot of work.
Okay.
Yeah,
Okay.
it's a lot of work. Operationally, they run very lean with the workers and all that. Great business, and the team's great. It's a family business at this point, so I do know
Yeah.
how I'm pretty close to the
What kind of
operations.
printing are we talking about? Like when you say commercial printing?
Oh, everything. From like their clients could range from churches when they need their like programs and things printed, to
Mm.
restaurants when they need menus printed, to political
Oh, okay.
organizations that
Okay.
need posters, to like marketing
Yeah.
companies that are marketing like the ballet or a race that
Mm-hmm.
they need like big. So they're the hotline or the Google like result that comes up when you're like searching like printing in Charlotte, if you
Wow.
need to get things printed or customized, things like that.
Is
It's
like
pretty cool.
Vistaprint like a competitor or
Oh yeah. Oh
yeah?
yeah. Oh yeah.
We don't talk about Vistaprint in this
No, we don't
family.
talk about fit different in these parts.
Got it. Okay, cool. I mean, that's so
Yeah.
interesting to me.
Yeah.
I would love to know one day like what the like how you even get to that point where you're like you're looking at franchises and you're like this
I
is it
know.
for
Well,
me.
that's and we had talked earlier when we had a conversation like what are your financial goals and things like that, and really I
Mm,
didn't think of it, but like the way my dad has like because a lot of people look up to their fathers or their parents.
mm,
I look up to mine, and
mm,
um, kind of where he's at. He's like nearing retirement age, and he's like just pursuing things that he had never pursued before. He's always wanted
yeah.
to start a business, and my entire family in India, they all have like retail stores. Like we're a very like merchant business family, and here he is, has been in corporate America for his entire career. I'm not going to speak for him. I mean, I don't know if he loves it. I don't know if he doesn't love it, but I do know that he loves this like little project that he has that's making him pretty good money.
I mean,
So
it's nothing like working on something that's like for you, you know? rather than
exactly.
for someone else. So that I
But I
get
don't
that.
think printing was like the, like I want to go into printing type of thing. I think
Yeah.
he was like looking at like
Yeah.
hotels, gas stations, and it ended up it was a printing franchise.
Well, it sounds like it's working out. I mean, has he been doing it for several years?
No, yeah, it's been a year.
Oh, it's been a year. Okay, okay.
It's
So
been a year. No,
this is in its
yeah,
infancy. Okay, got it.
yeah.
Got it.
So,
Okay,
trying it out.
cool. So, um, I know we've talked before a little bit about things that you're into, and one of the things that you told me you were into infinite banking. How did you get into infinite banking?
Yeah. Uh, another, I really would hate if I listened back to this and I say my dad on everything because like that's
It's
probably
okay
how
to
it's
be
gonna
influenced by your
go.
parents.
I know. Like, cause like, he's got all of these like financial strategies for me. Like he even prints out budgets for me. He's like, "Oh, you're spending too much money. Here's a budget." And like in my mind, I'm trying to be like an individual, like I'm trying
Yeah.
to like just do. So like I actually like
Yeah.
listen to him less because of that.
Oh wow.
But he's the savvy guy that I get all my tips and tricks from.
Okay.
But he's the one that got me on it, right? And he got me and my little brother to invest into this cash value life insurance policy with New York Life. I didn't really know anything about it at the time, um, but essentially the way it works, from my initial understanding at the time,
Mhm.
was you contribute a set amount every single month, um, to a premium essentially, and after X number of years, you have a value of this like life insurance that you can pull from if you choose to, and it's interest free, and you're essentially taking a loan from yourself. You obviously have to pay it back, but there's no interest. Um, I think there's a lot of tax benefits and time value of money benefits, and it's not expensive, and it's out of sight, out of mind. And I've been doing it for now about 7 years. It's coming to a time where I can potentially start making a decision on like if I maybe want to take some money out of it
Okay. Um, is
to
it too
fund something else.
personal? Is it too personal to ask like what your premium is, like how much you have to pay into it per year?
No, no, I pay about 100 a month, and I put down 10 grand to get it started.
Oh, okay. So an initial lump sum and then 100 a month. Okay.
Yes.
And do you have a sense like ballpark for what the cash value is inside of it right now?
Uh, Ballpark, it should be at least 250 by the time I'm 35,
Okay. Okay.
and I'm 28. So just like
Do you have a sense
back of the
for
envelope math.
do you have a sense for like what percent of the cash value you can borrow against?
That's a good question. Um, I have to look at it again. Sorry,
Okay.
I
Okay.
haven't seen it in a while. I haven't
No
accessed it in a
worries.
while. Yeah.
I mean, I'm just wondering because I know. So we had a guest on the show. His name is Drew Griffin, and he's super into infinite banking. And he was very particular about the design of his life insurance policy, and he had designed something where he could basically get up to 92% of the cash value, access 92% of the cash value, which is really high. Um, and so I was just curious to know if you knew what yours was. Um, he mentioned when he was on, he mentioned this book called The And Asset. Have you ever heard of that?
I have not heard of that book now.
You should check it out. I think it's like a very fast read, but it's done by this guy who I think he kind of grew up working at banks, and he is a huge proponent of whole life and using a cash value policy to access, additional funding to do all sorts of different ventures. But he's started a company called Better Wealth, and they literally focus on this whole entire strategy. And he said, the guest that we had on, Drew, said that that book like changed his life and the whole way he like approaches the concept of infinite banking and all that kind of stuff. But yeah, so it might be a good read for you if you're into it and you're trying to figure out what your
Yeah,
next move
no.
might be.
What is it called again?
The and asset.
The and asset. Got it.
Yeah, the and asset. And I think the guy's name is Caleb. The guy who wrote it is Caleb. And so at this point, you're building up the cash value, and now you're starting to think about, what do I do with it? Like,
Yeah, well,
you're
I've
thinking
been
about
so
borrowing
focused on
against
like
it.
accumulation, right?
Yeah,
Like just
yeah,
consistent accumulation, but then there's like tax efficiencies with it. There's investment value with it. There's savings value. There's a lot of other things you can do with it that I haven't really thought of because I needed to focus on accumulation. I needed to focus
yeah.
on the time. But after like about 7 years of doing it, I feel like it's even more appropriate now, especially as we had talked about before, more so like short-term slash
Mm-hmm,
long-term
mm-hmm,
financial goals.
mm-hmm.
This definitely plays a little factor in it.
Sure, yeah. Okay. Okay. So, I know you've got the infinite baking thing. It sounds like you're starting to get your stride there, and you're going to maybe look at sort of the next half of that, which is collateralizing a loan and actually using the cash value to your advantage. So infinite banking isn't really the only thing you're into. I know you invest in the stock market, so can we talk a little bit about maybe like what you're invested in, what your top positions are in your portfolio?
Yeah, so I am more so invested into ETFs. Um, I use Charles Schwab as my primary account, mostly because I had a 401k when I first started my career and
That's how
converted
it
it
starts.
to yeah, exactly, and then ended up getting a new job and paid the taxes on it, converted it to a Roth,
Oh wow!
and
So you
now
wait a minute.
and
You had a 401k. You
yes,
paid the penalty and converted it
yep,
to a Roth IRA.
yes, yep.
Okay. And was it because it was like a short amount of time that you were at
It
an
was a short
employer?
amount of time. It was only a
Okay.
year.
Got it.
And like I
Okay.
knew I was going to be spending more time at another company for other reasons.
Yeah.
And but yeah, so that Roth uh, currently
Hmm.
the positions I've taken on it are with two ETFs and a stock. So
Okay.
QQQ and SPY.
Hmm.
QQQ
Hmm.
has you know is done okay.
Okay. Okay. Like, I
uh,
mean, are you saying you're happy with it, or what are your feelings?
I mean these things like and this is like a psychological thing for me. It's like ETFs you can't like measure it based off of like week over week. It's the successes I've seen with ETFs have been through a much longer uh, term from a like a look back perspective. So like if you're looking at your ETF progress from um, 1 year or 3 years, yeah, it could look a lot better than the last 3 months, which is the case right
Sure,
now,
yeah.
and that's
I
why
mean,
I'm laughing. Yeah,
the last 3 months. I mean, honestly, when I look at any ETFs or any mutual funds, any index funds, I pretty much always look at like the 10-year, because the 10 years is like the best reflection of like a full economic cycle, and it's
yeah.
probably a better reflection of like that thing's performance over time. So you said you're into QQQ, and then what else? What else was it?
QQQ and SPY,
Okay, and then you said you had a stock. What stock?
NVIDIA.
And is it split up into thirds? Like how do you have it allocated?
Yeah, I my NVIDIA is about 25%, and my um, SPY, and QQQ are the rest of the portfolio in
Okay,
electronic
got
Roth.
it. Um, I'm just curious, like what made you go for those things? Like, what's your investing strategy here?
Yeah. Um, Before I was in ETFs, was trying to figure out, I was trying to get some traction in the stock market. I was like playing around with lower price stocks, trying to reach some sort of higher upside, and those kinds of plays. And I don't even know what to call the market now, like with these like in a bear market with trying to figure out some sort of upside was not the answer to my short slash long term investing, I should say. And that is the reason I tried to go down the ETF route
Okay.
over the last couple of years. And I sought my dad for advice, the
Yeah.
ETFs, and he
Yeah.
was like, "Son, I got some great ETFs and a great stock for you." And that's how I landed on these. And I've
Cool.
just ran with it.
Cool.
Yeah.
Yeah. Um, so just for listeners, the SPY is S&P 500 index tracking ETF. Um, QQQ tracks the NASDAQ 100, and then NVIDIA is just a company that's heavy in the artificial intelligence space. They're a semiconductor, probably the most popular semiconductor, I think, of them
Most
all.
popular semiconductor stock.
Um,
Yeah. And the semiconductor stocks are doing like have done quite well.
yeah,
Um,
yeah, yeah. Well,
so
I mean, I think the artificial intelligence, like guns race, has been, I think,
yeah,
the chief thing. But their chip, like semiconductors, are, think of the chips that go into pretty much everything you use, like your phones and video games and computers, etc. So it's an arms race between them and some other major semiconductors, but I think Nvidia has probably done the best out of all of them thus far.
yeah.
Um, okay, so when when you invest, so you have an account at Schwab, and you've got these three investments. Have you ever thought like, have you ever thought to yourself like, okay, um, do I have enough exposure and diversification? Like, has that thought ever crossed your mind about like, do you have enough diversification?
Oh, it crosses my mind all the time. And I don't have enough diversification, but I also like I feel like I don't want to have too much diversification. I've had too much diversification before, and I have like really not made a lot of money from it. So this is my attempt of de-diversifying, or like just being a little bit more simple with my investments.
Yeah,
But
yeah.
I definitely think a lot of especially the successes that I've seen from friends and family from their portfolio has been a largely more divest sorry like they're a largely more diversified portfolio. um
Mm-hmm.
it's not hard to convert it into a more diverse portfolio. I just have not in the last couple years.
Yeah, yeah. Um, I the only reason I ask is because like, I mean, I'm a geek about this stuff, and so I'm on Reddit, I'm on Discords, like yeah, I'm everywhere, right? And I see like this new crop of people who they're like, I'm S&P 500 or die, like they don't have any other holding other than an S&P 500 index like you have like an SPY. Um, I know QQQ is really popular. Um, I don't I don't know too much about that particular ETF, but I've heard some people talk about QQQM. I'm not sure if you've ever heard
mm,
of that one,
I
but
have.
I think people prefer QQQM to QQQ for the maybe its expense ratios or something silly like that. But like, not silly, but just something that's sort of like maybe more marginal. So it
Yeah,
might be
I
something you want
think
to look into. I don't know.
QQQM slightly has a higher return from my understanding.
And it could just be that it has less fees. Um, I know when I've heard people talk about QQQM before, I think I've heard them talk about the fact that it has maybe a slightly lower expense ratio or management fee than QQQ. And then SPY, interestingly enough, like I have an S&P 500 in my portfolio, um, and I have mine through Vanguard. I have VOO. It's the Vanguard S&P 500 ETF. Definitely one of my top holdings, but um, I think the expense ratio is like 0.03 or something like that. But Fidelity actually released a new. It's actually a mutual fund. It's not even an ETF. It's called FXAIX, which is I think is in a lot of people's like 401ks if they have Fidelity. That expense ratio, so it tracks the S&P. The expense ratio is 0.015%. It's the lowest expense ratio for any sort
Oh,
of
wow.
thing I've seen. And SPY, just so you know, so SPY I know is 0.09%. I knew that because I looked when I was looking for S&P 500 index tracking funds. I saw SPY, and SPY is the most popular index tracking fund for the S&P 500. It is the most popular by far. It's not even close. And the reason I think it's so popular is because there are a lot of people out there who trade options on SPY itself. And in order to do effective options trading, you need volume. And that's where all the volume is for the options trading. So I think a lot of people just gravitate towards SPY. But it does, I will say this, if you're not going to do options trading and it doesn't matter to you, there are definitely other S&P 500 tracking things that are like, that will get just the exact same performance, but will give way less on fees. Way less.
Mm.
Um, and I don't know if you've ever looked at like a fund fee calculator, but like the difference between like 0.09 and 0.015, it's significant. Especially like you're young, Monty, like over the next like 30, 40 years, you're going to have hundreds of thousands, maybe even $1 million plus in this thing. That difference in expense ratio is going to be huge.
Oh, I bet. Yeah, it's actually something that I don't really think about that often. 'Cause like, yeah, they don't seem like that high of percentages, but
They
in the grand
don't. I
scheme of
know.
things, yeah.
I know.
In the grand scheme of things, yeah.
Yeah. I mean, it's kind of wild because like when I started investing, I had VT-SAX and VTIAX in Vanguard. And those are two mutual funds, like flagship, like anchor, admiral share kind of mutual funds at Vanguard. And I would dollar cost average into them. So like every single month, I would put a certain amount in. I had like an 80-20 split. It was like 80% towards the VT-SAX, which is the domestic total stock market, and then it would be like 20% towards the VTIX, which is the total international stock market. Because I wanted like geographic diversification, but I'd been doing that for like several years, and then I realized like, oh my god, like maybe I should be in ETFs instead of mutual funds because the ETFs have lower expense ratios,
Right.
and so it's really good that you've kind of started from this mindset of like, oh, I need to be in ETFs. I know that, like, and that's great because like in a taxable account, those definitely are more tax efficient. You're not going to get hit with like the long term capital gains. You're still going to get hit with dividends. I don't think you can avoid that, but like
No.
it's still much more tax efficient. Um,
And like
but
if yeah, and like if you're like me and like don't really keep up daily with like the news and the like, oh, especially during
yeah,
inflation times and all of that, like that is
yeah,
like, in my opinion, that's like a really good move. If things are
yeah,
happening in the market, just like just putting into ETFs for now, like if you have a lot of like money in stocks, like yeah, 100% a good like solution. Not the best solution, but like a decent
yeah.
solution.
Yeah. I mean, I don't think like, there's so many people who are out there trying to like outperform the market. I feel like that's a crazy endeavor. And it's like so hard to be better and outperform the market. And there's all these active fund managers that don't outperform the S&P 500. It's like it's almost 90% of active fund managers don't outperform the S&P 500. So it's like
Hmm.
the fact that you've got money in SPY, just by history, you're going to outperform people who are actively sitting at a computer managing trades every day.
Right.
And that's just the power of like an index fund. But it definitely is worth it to look at your expense ratio. I want to put you onto one thing, which I think you should look into. I think it could change your life. It's M1 Finance. You're into ETFs and I'm into ETFs, and here's what I found. So like I have a significant amount of money in mutual funds at Vanguard, and what I learned is that I can actually Vanguard for free will allow me to convert my mutual funds to the ETF equivalent for free, no cost, no taxable event. The only thing is it's irreversible. But here's the catch. Vanguard says once we convert them, that's fine. They'll be converted and you'll get those low expense ratios and blah, blah, blah. But you won't be able to dollar cost average into these ETFs because we do not allow our customers to dollar cost average into ETF products. And the reason they don't allow for that is because the price of an ETF, it's like a stock. It changes all day, right? A mutual fund is priced one time at the end of the day. And so everybody gets the same price on a mutual fund. And so what they allow you to do at Vanguard is they can say, connect your bank account. And then like, if you say you want, $100 invested every single week or $400 a week or $500 a month or whatever, they will take that money from your bank account and they will appropriate it and fund any of your investments that you pick, so long as they're mutual funds. They will not do that with ETFs. They do not do that. And so I was like, well, I want the ETFs because I want the low expense ratios. I want the tax efficiency, but I want to do dollar cost averaging. And they were like, well, unfortunately, we can't do that for you. So
Hmm.
I did a bunch of research and I came across this thing called M1 Finance. And I've learned that it's like a very popular thing in the ETF community. Basically, what M1 Finance has done is they've set up an infrastructure for long-term investing. It's really designed for long-term investing, but you can basically set up what's called a pie, which is basically a portfolio. And you could say, here are the things that I want in the pie for you, right? You could say, I want, QQQ, I want, QQQM or, SPY or
QQQM, baby. Yeah.
whatever,
No,
right?
I'm
Like,
QQQ strong yet.
you can basically like set up your pie however you want it, right? And
Yeah.
you can actually set the percentages. And what's so cool about what M1 Finance does is number one, they do the fractional share stuff, right? So you can say like, hey, I'm going to send you $100. You connect your bank account. You say, I'm going to send $100 into M1. It automatically invests that $100 across your portfolio. But it actually does it in a pretty smart way. So you set up your investment strategy, right? Like let's just say you said, I wanted to be 33% in SPY, 33% in QQQ, and then 33% in, let's say, some other thing, right? What it would do, right? So imagine NVIDIA skyrockets, right? Like it has, right? It
Yeah.
skyrockets and you make all this money on NVIDIA. What it will actually do is it will recognize that and say, well, his investment strategies, he wants a third, a third, a third. Right now, we're over indexed on NVIDIA. So when I get this $400 this week from Monty, I'm actually going to allocate heavier towards QQQM and SPY. And
Does
it
it
will do that
automatically?
automatically.
Oh my God. Yeah.
Automatically. And what's
That's the
crazy
problem.
about
That's actually a big problem. Like
it,
on the flip side of, yeah, no, that's awesome.
yeah, it's like it kind of blew my mind at first because the I didn't I had never really thought about it. Like, and when I was doing Vanguard, it just sent the money in, right? Like 80% goes here, 20% goes here, and I never thought about it.
Yeah.
But then like I realized like, oh my God, I guess I am over indexed on the domestic stock market because that's been
Yeah,
booming for a while.
for
And
sure.
I looked
Yeah.
at sort of my holdings. I'm like, oh my, I'm nowhere near 80/20.
Yeah,
I'm nowhere
yeah,
near.
exactly. It's like it needs to adjust. Yeah, like
Yeah.
it's yeah, the
Yeah.
corrections have to be made.
Yeah.
And a lot of those times, like you can't really catch it. Like we have full-time jobs, like
Exactly. Exactly.
so, yeah.
So I've actually had I'm like I've fallen in love with M1 Finance, but I'll just say
I'm
this.
100% gonna look into it. I mean, you're like definitely
Yeah,
advocating for it. You've been talking for yeah, like 5 minutes. I'm like blowing my mind right now. Yeah.
you definitely should. I think it's the absolute best platform to do long-term oriented investing in ETFs, like an automated dollar cost averaging kind of way.
Hmm.
Because not only do you get better returns when you do dollar cost averaging, like when you're investing every week or every month into something, but the fact that it actually starts to underinvest in something intentionally once it's high up, like if it's appreciated a significant amount relative to the rest of your portfolio, that the fact that it will stop investing in that thing so much and start investing in some of the other ones, I think is probably going to improve returns even more. Um, but yeah, they're a great company, pretty easy to set up, and they are basically an alternative because you can't get that. So Fidelity, you can't do it at Fidelity. You can't automatically invest in ETFs at Fidelity unless you're willing to pay $4.99 a month.
Oh, I know that. Yeah, I use Fidelity for my 401k, so I was like already, like from a
Yeah,
efficiency perspective, like I'm trying to like use them for these kinds of things too. No, yeah, it's
yeah,
not conducive.
it's annoying.
Yeah.
And I think what it is like there's like two camps now. It's like the legacy people like Fidelity, Schwab, Vanguard, and then there's the new age like startups. Like you got like M1 Finance and Acorns and Wealthfront and Betterment. Like so there's been this sort of like divergence, and for whatever reason, Vanguard and Fidelity, it's like they just don't want to provide that service for free, you know?
Yeah.
And I think they've got too much at stake with their own mutual funds, so they just don't want to do it. Um,
Thanks for the tip.
for sure, for sure. And I want to know if you do get started. I want to know how it goes. I could actually refer you. I don't do any. I
Yeah, I was
don't do
gonna
any.
say, like I was waiting for the I was waiting for that plug.
I really don't
And
do any
my
affiliate stuff.
referral code is
I really don't do that. I actually, it's funny because I've talked to several people about M1 Finance, and I've had like 3 or 4 friends like sign up for accounts. And I thought to myself, damn, I should have should have gave them a referral link. But I really don't think it's that. I don't think I get much from it. I don't think I would get. I don't would gain that much from it. Um, and here's what I was gonna say is like you just like the life insurance stuff I think is good. You know, you're setting up, you've already set aside some like significant cash value, and you'll find ways to use that. But when it comes to your investments, my plea to you is like get that thing set up,
yeah.
get it automated so that it becomes just part of the fabric of your cash flow, right? So like when you go to say like how much can we afford to do X, Y, and Z, you're already factoring in like, oh, I do, 500 a month to this thing. And that's locked away. We can't touch it. It's already happening. It's already in motion. And that's what's going to set us up, right? Like we're taking care of the long term there, because the reality is this. Everybody talks about their 401k. 401k is not going to get you retired. You cannot retire on your 401k. You need
Especially not
more
with
than that.
inflation these days.
Yes, and especially not with like a Social Security may not go away, but it's not going to be anything near what our parents have. It's going to be much further reduced. And so you have to have some other means of investments. I think like for you, I would tell you like keep doing that stuff with QQQ and SPY, but like pump it as much as you can, like get to the 6,500 because you're doing that in your Roth IRA, like pump that
Yeah.
thing up to
I'm
the
trying to get it close to
6,500.
6,500 each year, but I
Yeah,
don't think I've hit it
yeah,
though. But yeah.
yeah, yeah, and keep pounding that, because the more you have, like if you're 28 years old and like the more you have done that stuff, like even if you did a lump sum and you keep dollar cost averaging into it, it's like if you get that thing started and it's just got that trajectory and it's got momentum, that thing can do wonders for you. You've got like, I mean, you're still young and you make good money. Like you should just you find ways to just get that stuff socked away in there and like just
Yeah.
going. Low expense ratio. You got the ETFs, like just like pump it, pump it, pump it. And then when you hit childcare, it's like, okay, I can slow that down. I'm not gonna stop it, but like I can like tweak it down a level and like get more cash flow and then use that. Like it's just about having it set up before, because I promise you, if you don't set this stuff up before, you will just be with kids and be like, "Oh, I'm gonna get to it. I'm gonna get to it. I'm too busy. Like, I'm
Yeah,
too
yeah,
busy. I'm
yeah.
gonna get to it." Um,
You're right, man. You're right.
and it's like the thing is, like, time is everything, man. Like the time. Like if I'm 36, you're 28. You got so much more time.
Yeah,
So you got to use that to your advantage. But
completely agree.
anyways, I'm that's all I wanted to impart.
No, these are important things to talk about, man, because at the end of the day, like, you want to be set up for success. You don't want to be worrying about still trying to build a framework with these like finances is pretty fundamental when you
Yeah.
think about it. So,
It's been a pleasure having you on, Monty.
yeah.
Um,
No, this is I've learned a lot. I mean, there's M1 finance, the flip system,
and
save
asset.
withdrawal rate, the and asset. Yeah, no, I
Yeah.
this is awesome stuff. I got my I have a basically a 28-hour flight in sometime in the next couple weeks.
Oh, you should definitely get
Like
that
it's just
book.
going it. So I'm gonna get that book and
Yeah.
go to town on it.
Yeah, for sure.